The different forms of business organizations. The word business originates from the Old English word business, which meant anxiety or care, referring to the state of being busy. Over time, the meaning evolved, and by the 14th century, it referred to the state of being busy with one's duties or tasks. By the late 18th century, business came to represent commercial or mercantile activity. A business is an organization or entity engaged in commercial, industrial, or professional activities. It typically involves the production, buying, or selling of goods or services for profit. Businesses can range in size from sole proprietorships to large corporations, and they operate in various sectors such as retail, manufacturing, finance, and technology. The primary goal of most businesses is to generate profit by meeting the needs of customers or clients, while also contributing to the economy through job creation and innovation. In today's dynamic business world, understanding the different forms of business organizations is essential for everyone aspiring to establish or manage a business. The structure chosen not only affects the way operations are conducted, but also has significant implications for liability, taxation, and access to capital. Businesses primarily operate as sole proprietorships, partnerships, corporations, or cooperatives, each with distinct features. A sole proprietorship is the simplest and most common form, where a single individual owns and manages the business. This structure offers complete control and flexibility to the owner. However, the major downside is that the owner has unlimited liability, meaning their personal assets are at risk if the business faces legal or financial difficulties. As the sole proprietorship grows, it may face challenges such as limited access to capital and difficulty in sustaining the business if the owner steps away. For individuals seeking to share the responsibilities and liabilities, a partnership may be more suitable. Partnerships allow two or more people to co-own a business, sharing profits, losses, and management duties. General partnerships involve all partners equally, while limited partnerships introduce the concept of limited liability for some partners. Typically, investors who do not take part in day to day management. While partnerships benefit from a pooling of resources and expertise, they can be prone to conflicts and disagreements among partners, and general partners still bear the burden of unlimited liability. On the other hand, the corporation offers an entirely different structure where the business is treated as a separate legal entity. This means the owners or shareholders are not personally liable for the company's debts and liabilities, providing significant protection. Corporation can raise capital more easily by issuing shares to investors. However, the complexity of incorporation comes with a higher degree of regulation, and corporations face the challenge of double taxation where both the corporation's profits and shareholders' dividends are taxed. Finally, cooperatives or co-ops offer a unique model where the business is owned and operated by a group of people for their mutual benefit, common in sectors like agriculture or retail. Co-ops promote shared ownership, democratic decision making, and equal profit distribution among members. However, their structure may slow decision making and limit individual rewards, which can be less attractive for those seeking strong individual control or profit incentives. Types of business operations. Business operations refer to the various activities that businesses perform to run efficiently and achieve their goals. These operations can differ depending on the industry, but generally fall into three main types: service operations, which provide intangible products like consulting or repairs; merchandising operations, which involve buying and selling goods; and manufacturing operations, which focus on producing physical goods. Each type of operation has unique processes and resource needs, all aimed at meeting customer demand and ensuring business success. Understanding the types of business operations is also key to understanding how businesses create value. Broadly, businesses operate in three categories: service, merchandising, and manufacturing. Service businesses such as consulting or healthcare provide tangible goods in the form of expertise or effort. Their value lies in delivering solutions to customer needs without the production or sale of physical goods. Merchandising businesses like retail stores focus on buying and reselling products at a profit. Their operations revolve around efficient supply chain management, inventory control, and marketing. Meanwhile, manufacturing businesses convert raw materials into finished goods, often on a large scale, requiring significant investment in production capabilities and labor. The complexity of operations depends on the scale and industry, but all aim to deliver goods or services profitably. Service business. These businesses offer intangible products. For instance, Accenture provides consulting and technology services. Their operation focuses on problem solving and advisory services, using intellectual expertise rather than physical products. Merchandising business. Amazon and Walmart are key examples. They buy goods from suppliers and resell them to customers without altering the product. Amazon operates globally through its online platform, while Walmart manages a network of physical stores. Manufacturing business. Tesla is a prime example of a manufacturing business. Tesla's operations involve designing, producing, and assembling electric vehicles. It transforms raw materials into finished products through engineering, production lines, and quality control processes. Users of financial statements. For a business to thrive, financial statements play a crucial role. These statements are not only used by internal managers for decision making, but also serve external users such as investors, creditors, and regulatory bodies. Internal users, such as management, rely on financial reports to monitor performance, allocate resources, and develop strategies. External users, such as investors, need these statements to assess the business financial health and potential returns, while creditors review them to determine the company's creditworthiness. Even employees and customers may be interested in the company's financial position, particularly in businesses where long term contracts or job security are concerned. Internal users of accounting. Internal users are the primary users of accounting. Following are the three types of internal users and their information needs. Owners. Owners need to assess how well their business is performing. Financial statements provide information to owners about the profitability of the overall business as well as individual products and geographic segments. Owners are also interested in knowing how risky their business is. Accounting information helps owners in assessing the level of stability in business over the years and to what extent have changes and economic factors affected the bottom line of the business. Such information helps owners to decide if they should invest in any further in the business or if they should use their financial resources elsewhere in more promising business ventures. Managers. Managers need accounting information to plan, monitor, and make business decisions. Managers need to allocate the financial, human, and capital resources towards competing needs of the business through the budgeting process. Preparing and monitoring budgets effectively requires reliable accounting data relating to the various activities, processes, products, services, segments, and departments of the business. Management requires accounting information to monitor the performance of business by comparison against past performance, competitor analysis, key performance indicators, and industry benchmarks. Managers rely on accounting data to form their business decisions such as investment, financing, and pricing decisions. In case of investment decisions, for example, managers would require the return on investment calculation on a proposed project supported by reliable estimates of the costs and revenues. Employees. For the employees operating in the finance department, using accounting information is usually part of their job description. This includes, for example, preparing and reviewing various financial reports, such as financial statements. Employees are interested in knowing how well a company is performing, as it could have implications for their job security and income. Many employees review accounting information in the annual report just to get a better understanding of the company's business. In recent years, the increase in number of shares and share option schemes for employees, particularly in startups, has fostered a greater level of interest in accounting information by employees. Moreover, potential employees are also interested to learn about the financial health of the organization they aspire to join in the future. External users of accounting. External users are the secondary users of accounting, following the 8 types of external users and their information needs. Investors. Investors need to know how well their investment is performing. Investors primarily rely on the financial statements published by companies to assess the profitability, valuation, and risk of their investment. Investors use accounting information to determine whether an investment is a good fit for their portfolio or whether they should hold, increase, or decrease their investment. Lenders. Lenders use accounting information of borrowers to assess their credit worthiness, their ability to pay back any loan. Lenders offer loans and other credit facilities on terms that are based on the assessment of financial health of borrowers. Good financial health is indicated by the borrower's ability to pay its liabilities on time. High profitability, substantial securable assets, and liquidity. Poor liquidity, low profitability, lack of assets that can be secured, or an inability to pay liabilities on time demonstrate poor financial health of borrowers. On a lighter note, borrowers can only get a loan from lenders if they can prove that they do not need the money. Suppliers. Just like lenders, suppliers need accounting information to assess the creditworthiness of its customers before offering goods and services on credit. Some suppliers only have a handful of customers. These customers could be very large businesses themselves. Suppliers need accounting information of its key customers to assess whether their business is in good health, which is necessary for sustainable business growth. Customers. Most customers do not care about the financial information of its suppliers. Industrial consumers, however, need accounting information about its suppliers in order to assess whether they have the required resources that are necessary for a steady supply of goods or services in the future. Continuity in supply of quality inputs is essential for any business. Tax authorities. Tax authorities determine whether a business declared the correct amount of tax in its tax returns. Occasionally, tax authorities conduct audits of the tax return filed by the businesses in order to verify the information with the underlying accounting records. Tax authorities also cross reference accounting information of suppliers and consumers in order to identify potential tax evaders. Government Government ensures that the company's disclosure of accounting information is in accordance with the regulations that are in place to protect the interest of various stakeholders who rely on such information in forming their decisions. Government defines and monitors accounting thresholds such as sales revenue and net profit to determine the size of each business for the purpose of ensuring that it complies with the relevant employee, consumer, and safety regulations. Auditors. External auditors examine the financial statements of the underlying accounting record of businesses in order to form an audit opinion. Investors and other stakeholders rely on the independent opinion of external auditors on the accuracy of financial statements. Public. General public may also be interested in accounting information as a company. These could include journalists, analysts, academics, activists, and individuals with an interest in economic developments.